Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, today we're going to go over some great data, talk about some home price forecast. We're also going to go over inventory numbers, mortgage rate predictions, some other stuff. This is all more data. This piggybacks onto the one we did yesterday, which was our 2026 forecast for home prices. Mm-hmm. Okay.
All right, let's go.
All right. So what we'll do is we'll just start with the 2025 home price. This is kind of backwards because we did 26 yesterday. Now remember, the 25 forecast was already in that. That was plus 1%. Home price is up 1%. And so this is an aggregate, kind of comes from this. The average of all 8 of these is 1.9% up. Zillow and Redfin basically saying from now to the end of the year will be down. Some of these are saying up. Fannie Mae 4%. It's super optimistic. Cotality. I don't even know who they are. HPS, NAR, Wells Fargo, Mortgage Bankers Association, Redfin, Zillow. They're the crash bros of the major firms. Redfin's usually the worst. They always predict something bad. Okay, Juana. These are basically just guesses. They don't really know, right?
Yes, that's true.
Okay, they don't know. What we do know is this, and this is active listing count. Now, this is June of each. Now, this is July, but this is active listing count as of June of each year. We have the most listings today that we've had in the last 5 years, since 2020. Basically, you could call it last 6 years if you include 2020. So this is what the crash bros are talking about. They're drawing this line going, oh, look at this inventory. It's the most since the housing crash.
Not so fast.
Okay, Juana, how many homes did we have on the market at the peak of the inventory?
Oh, we had like 17, 18,000, some ridiculous amount.
No, for the whole country.
Oh, for the whole country. I think it was something like 4 million homes or some.
4 million
like
houses. There were 4 million houses. Look at this chart. 4 million on here would be, if you're watching this on your TV at home, it's somewhere up on the second floor of your house or in the attic. It's 4 times as much. As a matter of fact, what's interesting is the crash bros will never show you anything beyond 2020. However, once you go over right here to 20 and you grab 2017, 18, 19, you notice we're just going back to normal market, right, Juana?
Well, not even that. We're still well below 17, 18, 19. And we can all agree that we have more houses today and we have more people today than we did in 17, 18, and 19. And yet our inventory is lower. So clearly we have insufficient inventory to meet the demand. The issue is that the demand is softer than it was then, mostly because, not because of where interest rates are, but because of where interest rates were. So what I mean by that is, if interest rates were 6% in 17, 18, and 19, people would have been okay with that. But because there was this, moment in time that was once in a lifetime of interest rates being 3%, that's what's giving people pause right now. They're still trying to get over I missed the boat at 3% and now I've got to get 6% and I'm just not ready to come to grips with that.
You know what's interesting is 2017, 18, 19 were not the sub 3% years. That's why the inventory was so low. The interest rates dropped substantially. Mm-hmm. Somebody came on the channel and said like a 2.25%. Mm-hmm. They weren't going to give it up. They were still like 4%. So what's interesting is here we are, June of 2025 is the end of this, where that white line is. Mm-hmm. We've almost doubled the interest rates we had back then. We still don't have the houses on the market. That's really the amazing thing. You would think that we would have way more homes available because people can't, there's no buyers anyway, but apparently there are, because there's more people buying, that causing inventory to not come on the market. Mm-hmm. Right?
That's true.
Okay, one of the reasons that Juana mentioned here is the mortgage rates. Now, this chart here is the mortgage rates and projections. These are all guesses. Nobody knows. We talked about this yesterday. We're in a cutting, long-term cutting, where the Fed in general tends to cut rates. What does that mean, Juana, when the Fed cuts rates? What are they doing?
So when the Federal Reserve cuts rates, what that is, it's the rate that banks charge each other, the overnight rate, and that through all kinds of mechanisms ends up trickling it to the 10-year note, and it's the 10-year note that actually is the benchmark for mortgage rates. So kind of in a roundabout way, the fact that the Fed lowers interest rates for the banks to lend money to each other, eventually it does trickle down to mortgages and car loans and things like that.
Yeah, there's a couple different ways the Fed can stick money in the system. One is to drop interest rates. The other is to actually sell treasuries they can buy treasuries. When they buy treasuries, what happens is they buy treasuries back, put them back into the vault or whatever, and then they give the money back to the people, and then they go do something with that money, right?
So when the Fed buys treasuries, interest rates go down, and when the Fed sells treasuries, then interest rates go up for the rest of us. It's an inverse relationship with the treasuries themselves.
They also have this thing called the reserve rate, which is the percentage amount of reserves they require Federal Reserve member banks to keep, is a ratio of the loans they have, and I don't think that's changed. I think that's a fixed thing. I don't think they've ever used that because it's something they probably don't want to mess with. But what's interesting on this is now the numbers that they have here, 6.8 is what they're saying, the current, it's actually a little less than that, is that they're predicting all these three, Mortgage Bankers Association, Forecast, Fannie, and Wells, are all predicting basically less. You have the Wells Fargo saying 6.6 by the end of 26, and then 6.1. Now 6.1, if you have good credit, you'll probably be able to get under 6. And if you do a 15, you'll be able to get close to 5. Mm-hmm. And if you're doing a VA 15, you'll definitely be able to get under 5, probably, because this is the 30-year median kind of thing. But there are ways to get your rates down below that based on because that would be for like a medium borrower.
Right. So the way to get your rate lower than that is, number one, you have excellent credit. Number two, you have great debt to income ratio, meaning very little debt and good income. Number three is you have a banking relationship. So, and we've talked about this a lot. So for example, if you have your 401k or something like that, and you have a good bit of money with an institution, they're more likely to give you half a point off your mortgage as well. So there are all kinds of ways that you can get a lower rate, providing that you check enough boxes.
So 3 years ago, when interest rates started going up pretty quickly, a bunch of people, Crash Bros, other people, oh my gosh, wreck housing, 50% price decline, yada, yada. And we said, moderate.
Right.
Moderate sort of means they won't go up, they won't go down. They'll probably bounce around a little bit. There'll be some markets up, some markets down. Here we are 3 years later, and this shows 20 of the 50 largest metros have had falling home prices. This is year over year from June to June. We generally don't measure June to November. Why don't we measure June to November?
There's nothing fun going on June to November. June to November is this period where the spring is winding down. Summer not a whole lot happens over the summer, and November is kind of the end of it all. And it's that's the time of year where only the serious buyers are out there because they're trying to close escrow by the end of the year. So that's kind of the whole tail end of the buying season.
It would be like toy manufacturers and, comparing November and December sales to March or June or whatever. It wouldn't matter. Okay, so we're measuring June to June, year over year. And of course, we have 30 markets that are in the green. One of my favorite ones, Las Vegas. We're in the green. We were up year over year. We've actually been up year over year every year. We were pretty much even in 2022. We had like kind of a dip, spring to fall, then went right back up. And then by the fall, matter of fact, this is funny. When a lot of people criticized us in, I think it was May, when we made that prediction. And the home prices fell a bit. But guess what? By the next May, they were higher. Mm-hmm. So year over year, they were higher because they did drop, but then they shot right back up. And here we are again, the same things happened year over year in Vegas. Now, some of these markets, now if you look at Austin, Tampa, for example, they're just a little over 5% down year over year. Mm-hmm. What do Austin, Tampa, Dallas, Phoenix, San Antonio, Orlando, Miami, Jacksonville, and Atlanta, what do they all have in common?
Sunbelt.
Okay, but why are they all down the most?
Well, they also had the highest and fastest appreciation. So when you have a spike up, then the market generally has a pullback, whether it's real estate or stocks. The market generally has a pullback to kind of find its footing again.
Yeah, Austin home prices are up 80%. They went up 80% from 2020 to 2024, and they backed off a bit. This is not like, oh my gosh, because whenever you see, and I see this all the time when I go on Twitter or wherever and I find Crash Bros, they'll always have these charts. It'll always be Austin or Tampa or something like that. And that's all they talk about. They'll talk about, and they won't even show the last 5 years. They just show the last 2 years. Look at what it's done. And then they scale the chart. So it's like from the top to bottom, it's like home prices went to 0 or something. And the home prices are up like 70% from 5 years ago. But they won't want you to know any of that. So we thought we would share this. What this really says to me is the market probably has gotten this is the natural how markets work, right? They market forces. Mm-hmm. So we probably are closer to equilibrium than we were at any time in the last 5 years. I felt like most of the last 5 years, we were in various states of disequilibrium. Disequilibrium is home prices were going up because of massive buying pressure, mm-hmm. and then some disequilibrium in markets because of interest rates.
Right.
And then disequilibrium because people were locked into mortgages and people weren't selling.
Yep.
Okay. So that's basically, that was it for the charts. That's what we wanted to show you. I don't think we have anything else here. That was it.
Okay.
So, yeah.
All right, well, that was fun. Hope you enjoyed it. Leave us your real estate related comments. We appreciate them. Like the video, subscribe, hit the notification bell, share the video, and as Todd likes to say, if you watch the video in the first 48 hours after he posts it, it should be commercial free.
So you should reward us by subscribing to the channel if you're not already a subscriber.
All right. We'll see you guys on the next video. Bye.
Bye.